So we're going to start with the most basic things, which is demand and supply in economics. And demand and supply basically is a graph that shows the relationship between price and quantity demanded or quantity supplied. Okay, so we'll start with the supply curve, very simple. The idea of the supply curve is that the more money that a producer can make, the more likely they are to produce a particular quantity. So positive relationship between the price of a product and how much people are willing to produce at that price level. The demand curve is exactly the opposite. The cheaper something is, the more likely it will be demanded in higher quantities. At the intersection of demand and supply is what we call equilibrium position. And the equilibrium position is what we observe, which is the quantity of a product that we see in the marketplace with the price level that we observe, and the price level that we observe is the equilibrium price. Now, normally what makes changes in the price level of any commodity is a movement either of the demand curve, shifting to the right or to the left, creating new price and new quantity demanded equilibrium, or a shift of the supply curve. So this is, in a nutshell, the relationship between price and quantity for a normal commodity or a normal product. So previously we talked about demand and supply of a product. When it comes to money, it's a little bit different than demand and supply. Why? Well, because money is controlled by the government. So here too, we have the quantity of money, and the supply of money is what we consider kind of a fixed supply. Why is it fixed? Because the government decides how much money is in circulation. Okay, the demand function still looks the same, right? The demand function is the demand for money. The cheaper money is, the more demand there will be for money, right? So what is the price of money? And what is normally, this is price, but what is the price of money? The price of money is the interest rate that we observe. So the equilibrium price of money is the level of interest rate that we observe when we want to take a loan on a car, we want to take a mortgage out, right? So now one way that the government stimulates the economy on a regular basis, and especially after crisis, is by increasing the money supply. There are various mechanisms to increase the money supply. Most of all, buying and selling bonds in the open market, government bonds. And let's just say you increase the money supply now to S1. In this case, what you will see is the total money supply will go up and the interest rates will go down. Now, why do we want to bring the interest rate down? Well, because interest rate stimulates investment. The lower the interest rate, the lower the cost of capital, and therefore the more businesses are willing to invest. So it has a stimulative impact on the GDP, and theoretically should increase the level of employment or level of economic development as a result of a decrease. There is a point under which the interest rate is so low, it comes to zero or below, in which a decrease in interest rate no longer stimulates the economy. That's called the liquidity trap. Okay, so now we want to talk a little bit about the components of the economy. And the economy as a whole is measured by the gross domestic product, or everything that is produced in a given year. And it consists of what consumers or individuals like you and I buy and sell every day. It consists of investment, which is what is actually consumed or produced by businesses. It consists of government, and it consists of foreigners, so exports, minus imports, what we buy from other people. So the overall economy in a given country is divided mostly consumption of individuals, then businesses, government, and the foreigners. In the case of the United States, the sum of these two is actually negative. That means you have a trade deficit. Trade deficit is bad for the GDP, right? Because the bigger it is, the GDP will go down or will not increase as much as a result of a trade deficit.
Yeah.
So basically, we have three policies the government can use to stimulate the economy. One is called fiscal policy. Fiscal policy involves the manipulation of tax or government spending. So the way tax works, you reduce the tax, usually on consumers. This increases the consumer's income, and they spend more, and therefore it stimulates the economy. Or that's usually what the Republicans prefer, or what the Democrats prefer. They prefer to spend through government. So government can just simply spend more here by investing in infrastructure, investing in other kind of projects. Then you have monetary policy. Monetary policy is what is used to increase the economy by lowering the interest rates. So that means changing the money supply. And this usually affects businesses because it affects the cost of capital. And when the interest rates goes down, it's cheaper to invest in machinery, it's cheaper to invest in oil machines, in computers, and as a result, you're willing to take bigger loans, bigger investments, and that stimulates the economy through businesses. And the last one is trade policy. And trade policy is a way to stimulate the economy through the exports and imports. So you would put a tariff on the imports and you reduce the imports, or you either reduce the imports or you promote the exports. In either case, you're increasing this. So to summarize, fiscal policy belongs in the consumers and government spending. Monetary policy has an impact on investment, and trade policy has an impact on exports minus imports. Now, the problem is each one of them has limitations. Fiscal policy means the question is, how do you finance it? And usually you finance it by printing more money or taxing the consumer.
And what's the problem by printing more money?
If you print more money, you of course also stimulate the economy by lowering the interest rates. And for a short period of time, that can work because you can go into debt. And as long as the economy is growing, the relative debt could stay similar. It's the same, So as long as the economy is growing, you could still. It's like if you get a bigger salary, you could take bigger loans to buy a house, right, or bigger mortgage, because you have a bigger economy. And the trade policy, well, you could try to do that, but then that affects other countries because if you export more and import less, somebody else is exporting less and importing more.
Yeah.
So it's a beggar thy neighbor policy, right? You can further your own interests at the expense of your neighbor trading partner interests.